Yes, good morning. And as you say, the market reaction wasn't so clear cut as you'd imagine with inflation at 7% and the unemployment rate below 4%. And this is largely because there was a lot to unpack in that CPI release. I tend to side with President Biden in the sense that there is going to be some disinflationary effect down the line. And I think that's what we saw in yesterday's CPI release. It didn't show the broadening and the pickup in momentum in the broadening of the inflation pressures in different components of the CPI release. And most of the upward pressure tended to be concentrated in areas such as used car prices still, even though there was pressure from other areas like those that impacted by the increase in low wage incomes. So what we didn't really see is kind of food prices really take that next leg higher, other areas of retail services. And these are the areas that's going to be hit in January and in February by the Omicron variant and the reduction in demand. So what we didn't really see is kind of wholeheartedly robust inflation reports that not only confirmed the really hawkish priors of markets, because we're not just talking about a market expecting 4 rate hikes, we're also talking about a market that is discussing very early quantitative tightening on top of this. And so the CPI report didn't really kind of suggest that this is then a kind of a known factor and a known dynamic going throughout the year. And it also suggested that actually these kind of intermediate to back end yields might not actually be able to keep up with current market expectations. And this inflationary pressure may actually be able to come down a lot quicker than what markets were previously pricing following the November CPI report.
So, Simon, where does that leave us with regard to the right value for the dollar at this stage and how you trade that?
Yes, we've always argued that we don't necessarily see the market pricing for this year with regards to rates as too aggressively high. We think it's actually about right with what we're seeing from different Fed members. But what we are noticing is that there are asymmetric risks. So the risk profile to the dollar is downwards, and that's what we've seen really over the course of the year so far, in the sense that FX markets have been a bit more resistant than other markets to the change in the US rate landscape. And as we come into this year and we see kind of labor market dynamics and inflation dynamics become a bit clearer over the next 6 months, we think there is that expectation or the potential for the Fed to underdeliver, in the sense that it's going to be very difficult for the US economy to really push market pricing of the normalization cycle higher. So we're looking at different aspects, for example, cable, where there was this cap in a yield perspective of, well, the Bank of England's really going to get to 1% maximum this year. The Federal Reserve looks like they're going to match that, and then potentially then some with taking some more aggressive quantitative tightening. And then we talk about, well, where's next for the rate landscape there? And the question is becoming a bit more clouded from the US perspective as opposed to the UK perspective, and it can actually start to alleviate some pressure on these currencies, which is why we saw the market reaction we did in yesterday's market following the CPI release.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.